So we're starting today, and we've got a lot to talk about. The thing I'm thinking about the most, and obviously is probably on everybody's mind, is how is Trump reshaping policies? How are we going to look at the 2025? I kind of want to just get Dimitri's 2025 outlook. And one thing we talked to Dimitri a few times, the idea of bringing him in here is he's a geopolitical expert. He really understands the global landscape, and this is why I love talking to him because geopolitics are where I always kind of end up anyways. And Kevin and I kind of end up in that same arena. And just bringing on Dimitri just to kind of get your opinions. I kind of want to kick it to you guys. What are you seeing 2025, Dimitri? Are you thinking of anything specifically? And also, thanks for coming back on, man. We're always happy to have you.
Yeah, great. It's great to be here, Jason. It's great to be back on the show. So in terms of the 2025 outlook, I think it's really interesting if you look at Trump's policies because there's a series of deflationary and inflationary aspects. So immigration, that's inflationary. All right. So what we're going to likely see from him is a systematic approach. So they're going to go after easy targets. So illegal immigrants that are criminals. So they'll probably go after that first. And it would be like a tiered system, meaning they're not likely to go first for the service workers, for the construction workers, for the agriculture workers, of which illegal immigrants, particularly for construction and agriculture, constitute a very large percentage. So they're not likely to do that one first to the extent that that has upside inflationary risks, because even if, let's say, Americans fill that gap, they're going to want to be paid American wages. What that'll then mean then is that those higher costs will be pushed onto the consumer unless the government subsidizes, which I don't see happening. So that's inflationary. Tariffs are also inflationary, but they're also deflationary because we saw how even though the price of goods like washing machines, shoes went up during his first term when he imposed tariffs against China, there was also a deflationary aspect to it to the extent that global trade shrunk from like over 4% in 2018 or 2017 to like 0.4% global trade growth. So it was a not small amount that we saw. That aspect of it can be both inflationary and deflationary. When it comes to deregulation, that's definitely, and increasing supply side efficiency, that's deflationary. When you look at his energy policy, which can be best summarized as drill, baby, drill, that's also deflationary to the extent that it will lower a key energy input, and that can help lower overall costs. The question is, which of these forces cumulatively will have an inflationary or deflationary effect? What markets seem to think, specifically bond markets, is that they seem to think that it's going to be inflationary because we continue to still see higher yields. And funnily enough, the country that you would think should have higher yields actually has really low ones now, which is China. Their bond yields have just been plummeting, and that in itself could be a whole different discussion. But in terms of the outlook for this year, I think you're going to see a lot of the same stuff when it comes to using Section 301 of the Trade Act of 1974 that enables unilateral trade action and allows you to bypass the lengthy arbitration process that's associated with like organizations like the WTO. So I think you're going to see a lot of volatility there. I think if you see tariff wars, or rather you see tariff agreements and subsequent trade wars, what you're going to end up seeing is potentially countries saying, look, we won't lower tariffs, but how about we buy we buy a certain amount of energy that would be equivalent to the revenues generated from tariffs. I think India is looking to potentially do that. So I think you're going to see a lot of policy-induced volatility this year. I think markets are preparing for it. I think what will amplify it is that you're seeing a lot of intersecting trends like energy and AI that are going to further complicate it. And I think potentially amplify that volatility. That's my sort of short-term outlook. As far as the trading idea behind this goes, I'm very bearish on oil. I think geopolitical volatility in the Middle East will push oil prices higher erratically to the extent that it'll pose a supply chain risk. But I think fundamentally the fact that OPEC is is extending its oil cuts from December of 2024 to December of 2025 is indicative that they're not expecting a huge change in growth to the extent that they'll see a huge demand for oil. I think trade wars will play a really big role in pushing down demand for oil and dampening oil prices, much like it did during Trump's first term. But that's sort of my short take on it.
No, I love that because there's two different sides of it. One is, the long-term implications of inflation, the short-term implications of inflation. And tariffs are a very complex thing. They do push prices up, but also, like you're right, but at a certain point, it depends on what you're putting tariffs on to, which I'm sure you know more than even I do about that. You put tariffs on something that's such a big need, it could hold prices up for a little bit longer, and put more pressure on prices in the meantime. Something like washing machines and so on, people might start doing different things or buying local or something. There's a lot of different ways to look at it, but I just love the idea of, yes, it's dynamic. Trading is always dynamic, and I think a lot of people don't think about that. In the short term, yeah, we could see some upside. In the long term, here's what we're looking at, and I love that you brought that up, Dimitri. Kevin, what do you think about that situation? Do you think inflation in the short term is moving higher? I know we talked about oil here and there. Oil has moved up a bit, but it's kind of to the top of your range. Somebody was like, "Oh, Kevin's been bearish oil." No, Kevin actually said the range of oil, and it's actually sitting within that range still. So, Kevin, what are you thinking about oil here? Where do you think it ends up? Do you think the tariffs will put any pressure on it? Do you think the tariffs are just kind of a joke right at the moment? Well, what are you thinking right now?
Yeah. So I would say I felt like the $80 level was kind of that top range that we could see a reversal. And we're seeing that right now, right? It's down to $76.11. So we have had a little bit of a pullback here. I do want to preface this, and I'll get to your question. I do want to preface this by saying, like, look, there's going to be a lot of just volatility regardless. Volatility doesn't mean that things go down. Volatility just means that we see excessive price movements either to the upside or downside. So I would, if you're a trader for the next couple of weeks and you don't have to have exposure, because some traders do have to have exposure, right? Depending on you, especially if you're an institution where you have to have some form of exposure. But if you don't have to force a trade right now, I don't see a reason why to force a trade and let all of this stuff settle out. There's a lot of unknowns. Yesterday was actually a really good example of that. If you looked at the futures market, I mean, S&P 500 was up like almost 1.3%, 1.4%, because we didn't see anything around tariffs at the start of the day. And then, towards the middle to the end of the day, he makes a comment about 25% tariffs on Canada and Mexico. And you saw the market then go down, and it was negative 0.5%, and then ended up closing, up 0.3%, right? Like that's the variability that you're going to get within this administration. This is just the same thing that we saw in the last one. So I wouldn't force any trades if you don't have to, unless there is something that's more secular trend driven. There's no reason to put excessive risk out in the portfolio right now when we're still trying to figure out what the hell is going on. As far as oil, so my thing with oil is that I need to see some demand side drivers in order to keep prices sticky, and we're just not seeing that. And in fact, you're actually seeing exports of U.S. Produced oil actually declining right now. Gasoline consumption demands and petroleum consumption demands are for the most part holding intact. But everything that we've seen over the last 3 weeks, 4 weeks have been supply side driven. I won't go over all of that. Like, if you guys want to watch the previous videos, we do a big rant on that. But that's a big thing. And one of the big supply side events is actually weather. And we're getting that weather event today, right? Like, today is when we get hit. So you're seeing also this weather premium being faded out. And you're not even seeing that just with crude right now. You're seeing it with natural gas. Natural gas is down to 3.78, right? A week ago, Natty was trading at $4 and change. So a very volatile product, but you're starting to see that weather premium coming back out. Here's the thing when it comes to the oil side. Drill, baby, drill sounds nice in a political rally. The practicality of that type of policy without tax incentives, that's pretty much all they're going to be able to provide, in my opinion. Without tax incentives, there's not going to really do anything. Companies are not going to spend more money on infrastructure when they know that your policies is really trying to push prices down. You push prices down, margins go down. So there's no real incentive there. They're probably going to tell him that they're going to do a lot of stuff, but the actual actions, I don't think is going to really take place. Tariff policy on Canada and Mexico actually could be a problem. So for Canada, they actually export a lot of heavy crude here in the United States, which we refine that, right? And we have the refiners to be able to handle that. A lot of the production that we have here in the United States, light sweet, our refiners, we have them, but we don't have the mass. And it's not like every single refiner in the United States can process light sweet at an acceptable cost. There's ways that you can do it, but you have to add chemicals to it and yada, yada, yada. Okay. So that's a problem. Tax, you tariff Canada can come back and say, okay, let's slow down oil exports, which it sounds like that's actually on the table, which will be a problem because that will push prices higher domestically here for us in the United States in the near term. Other side of that, Mexico, right? People don't understand this. Mexico is a huge exporter of gasoline to the United States, right? And we export our crude oil out. So you tariff them, they could have a reciprocal action when it comes to gasoline. So that's also a problem there. So I think that there's definitely inflationary pressures if we hit the right allies. And unfortunately, the two that we have on the map are probably not the most important ones for us to hit right now. But that's what he's been running on. He's probably going to follow through on that. But I don't, until you get a demand side factor here, I find it very difficult for crude to kind of remain at elevated levels. And in fact, you're seeing actually this positive price correlation between crude and the dollar, which is something that you usually don't see. So yesterday, dollar ripped to the downside. Crude was kind of ripping to the downside as well, because there's not the expectation that the lower dollar is going to rapidly increase oil exports at this point, right? And so that's also something at some point that will shift, but you're not seeing the same type of reaction like you are with grains. Like grains are ripping face right now. That's because the expectation is that export demand is actually going to go up because the dollar is going to go down cheaper. So that's kind of where I'm at. And once again, I will say a lot is up in the air. There's going to be people that speak on this man's behalf from the administration that will say one thing and he will undercut them. That's not anything new either, right? So let everything marinate out a little bit. If you don't have to force something, don't, because you could have your face ripped off in a matter of seconds. Yesterday, everybody, and I'll kick it back here. Yesterday, everybody's like, oh man, look at the Mexican peso. Like, it's gaining strength. We're not putting any tariffs on. Ripping everything in every emerging market currency against the dollar was actually gaining a lot of strength. That fizzled in a matter of an hour and a half. That's the reality, and you usually don't see that type of currency vol. And currency vol probably will be a theme over the first half of this year to be mindful of too. So that's kind of where I'm at.
Well, so Kev, you brought something up earlier regarding oil prices. I mean, that part I definitely agree with you when it comes to companies may be hesitant to lay out additional capex, because historically, actually, I think the 5 biggest oil companies, their capex over a 10-year period is actually down 50% from where it was a decade ago. So they're not likely to reinvest all of that as they've shifted more, as I understand, to focusing on paying out dividends to shareholders. So they're not going to reorient to capex. But also, you talked about some of the secular themes. One of them is the energy transition. I don't think it's a coincidence that a lot of these oil companies are also diversifying into looking into lithium and looking into other transition metals. And so that was an interesting point that you brought up. Couldn't agree with you more about short-term volatility. And like you said, if you don't have to force a trade, don't place one. With me, like I don't usually do short-term trading. I like to do long-term thematic investing. So an example of that was I was doing quantum computing back in, I think, October of 2023, saying like, hey, I think this is going to be a really interesting thematic investment vehicle. Here are the secular forces affecting it. And yeah, we did see some short-term volatility when Google announced quantum supremacy recently, and then afterwards, NVIDIA poured cold water on it and went down. All of the securities were down like double digits, I think, except the one I invested in, which was QTUM. That one was highly diversified and it was able to withstand that kind of volatility. But I think as far as secular themes go, if you can find thematic investments that capitalize on that, specifically intersecting ones, and a great example of that is energy and AI, that can be a good way to weather volatility, for both near term and over the medium term from a lot of Trump's policies.
I agree with you. I think that some other ones too, and these are not recommendations, but I've been bringing them up for the last couple of weeks here. And now, I mean, they've already had a follow through, but I think you're going to start seeing this theme now, right? if you look at the beginning of his first administration, what was he really trying to do? Like, we have to remember this guy is a real estate guy that likes to build things, right? And so you have a situation where it seems like he's going to have an announcement here today. That is his first thing that he's going to really try to. He wants to build stuff, right? He wants to, he wants to, deport people and do all this other stuff and yada yada. But he wants to build. So over the last couple of weeks, if you kind of look at it, the industrial sector, actually last week and a half, the industrial sector has caught a really nice bid. And actually, if you look at industrials up today, I'm just looking at the XLI, it's up 1.66%. And industrials really don't have moves like we've seen over the last week or so since the 13th. If you look at since the 13th, just high level, industrials are up 7.3%. Another side of that too is going to be materials. Unfortunately, you also have the California wildfires, and so materials are also catching a bid. I mean, these are areas where if you want to kind of, I don't want to say hide out, it's not a recommendation, but go back and just pull out the playbook that we had in the past. It's pretty simple. I mean, he's going to try everything that he's going to announce here is going to either be data center driven, or he's going to be trying to figure out some form of infrastructure, or who's building out the next project. Materials up almost 8%, darn near probably up 8% since the 13th, right? And so there's areas of this market that just are not really sexy, but are actually relatively cheap compared to a lot of the peers out there. Technology is going to be another one where I feel like you're going to see a lot of vol, and it's going to be a tough trade because right now technology, these giants are in his good graces for now. But if some of the policies that he has goes into effect, and you do see kind of this battle between China, I mean, there's a lot of major companies that still have China exposure. Actually, all of the Mag 7 for the most part have China exposure except for Meta. So you still have some exposure there. So I think you get back to the nuts and bolts. I think that's going to be an area of kind of focus. And then also kind of looking at real estate, which I hate saying that because yields. But I think that you're going to see like Class A real estate properties kind of gain a little bit more traction as he kind of talks about those and tries to do a lot more deals too. So.
No, I like that. And so the one thing I'd like to ask both of you guys, and then Chris, we'll get to your question because I think that's a phenomenal question. I could talk about debt and different countries all day long. But I want to just ask both of you guys, what did we learn yesterday? What was something that traders and investors could take away from what we saw yesterday?
I mean, I'll go first because mine's really short. I don't think. I mean, Kev, you talked a lot about the volatility, like in the S&P. I think it was specifically. In my view, I don't think markets really didn't see anything they didn't price in before. That's my take on it. I think where the volatility may come in is the magnitude of his zeal, and that's where immigration policy comes in. I think, in other words, it's not that markets are surprised that he's looking to impose tariffs. It's not surprising that he's looking to carry out these mass deportations. It's to what extent is he going to do it? I think that's the uncertainty, not the action itself, but its magnitude. And from yesterday, it didn't seem that markets were overly surprised. I know he signed like 200 executive orders, which if he goes at that pace, he's going to be, I think, the president with the highest number of executive orders issued in a long, long time, I think since Reagan or before. And some of these policies, they had to do with the economy, and affected markets, but a lot of them, in my view, didn't seem to. That's at least my takeaway. I'd love to hear yours, Kev.
I didn't get anything. I mean, we've traded with this guy before. I didn't get anything that was anything materially different.
Yeah.
And so I just feel like you got to be a little bit more nimble. I would say, I mean, we focus on technicals a lot here, but over the next 2 weeks, 3 weeks, actually, I would say the next month, keep your technicals on there, right? That is our guiding light for these markets, but you got to kind of discount them a little bit too, because things can change on a dime. And I think that erratic behavior is one thing that yesterday we also have to kind of put it aside too. It was a holiday, very low liquidity. I mean, if you kind of look at the E-mini S&P 500 book depth, we only had like 7 contracts on the bid, 7 contracts on the ask. So it doesn't really take much to kind of move markets on a day like yesterday. Today, we have a little bit more of a back and fill, a little bit more liquidity. So the price volatility probably shouldn't be as aggressive. Now, what you will want to keep on the radar is if liquidity starts to come out a little bit because there is a lot of uncertainty, then that's when you get the price vol. And honestly, I feel like volatility is just relatively cheap right now on the equity front. Like if you wanted to buy hedges or you wanted to buy vol right now, like now is that the time to do it. From seasonal standpoint, vol usually starts to actually increase. So we had some technical stuff where we are seeing some follow through MACD crosses and stuff like that for the mini S&P 500 and the S&P 500, right? Let that play out for next 2 days, 3 days. You can see that follow through. That's usually the trend that we've seen over the last 2 years. But I honestly don't think that we are out of the woods yet. It doesn't mean that I'm bearish. I just feel like we got to definitely kind of recalibrate, because he adjusts his own policies based on what he perceives as the narrative in the market, right? And so there's some times where he's not going to, like, I got to set the record straight. Yesterday probably was I got to set the record straight. He probably got done with one thing. He probably looked at the markets and they said, oh, he was just BSing about tariff policy. And he was like, okay, let that be the number one thing. Like his executive orders kind of highlight April 1st as when his policies are going to go into effect when it comes to tariffs. What did he do? He moved up the timeline to February 1st. You're talking about putting tariffs on in the next 10 days, right? Like, what if we do that? What's the market going to do? It's kind of going to reverse all of the stuff that we have there. So I don't think that we learned anything new. I also say this too. We had the Trump bump in equities that did fade. Okay. Enthusiasm of commentary fades after a while, and people get back to the reality of where the market's at right now. What's the hard data looking like moving forward? And there's still a lot of stuff that's on the radar. Earnings season's just ramping up, right? We have Netflix, I believe, coming out today. I mean, like, there's still a lot of things on the radar that could give us a lot of boost to the upside when it comes to equities, or push to the downside here. So I don't think we learned anything new. I think there's this facade right now, or this what's the word I'm looking for? There's like this there's a star, right? There's a light in somebody's eye right now. Everybody's like so amazed and kind of taking in the moment.
Rose-colored glasses.
Exactly. Yeah, and I'm not in a negative way against him. That's just what we are doing. That's the election bump was the same way. It, like, everything's sunshines and rainbows, but Trump, let's be clear, he has a lot of headwinds coming up here. I mean, he got an economy that I would say is actually relatively strong in some respects, but there's some cracks, right? And so, like, he's going to have to continue to maintain that type of stuff and to keep that up. And what he's going to need to have is his Treasury Secretary. I will say this: his Treasury Secretary's got to do the same thing that Yellen did. People hated Yellen's strategy. There's no way around it, because if he goes on the long end of this curve, he's pushing yields up. And no one wants to see yields being pushed up right now. Jerome Powell is not going to do anything. It seems like, in my opinion. So he still has a lot of stuff to go. So honeymoon phase right now. Let's enjoy it while we have it here. But at some point, we kind of got to get back to the reality of the situation here. And the reality of the situation is inflation still sticky, probably until March, once we start seeing the residual effects of energy prices starting to come down here a bit. That's going to relieve a little bit of pressure. And then we kind of, navigate how many cuts we're going to get moving forward here. That's just kind of how I take it. But
so Kevin, do you think that inflation, because as I understand it, the two biggest, I know one of the biggest inputs in CPI right now that's really holding everything up is auto insurance. And I forget what the second one is. And I think it might be rent, if memory serves.
Shelter, yeah. The OER.
Shelter, right. Thank you. Shelter. So it's shelter and auto insurance. Those ones, as I understand it, are exerting disproportionate pressure on CPI relative to those other inputs. So do you see those two things coming down by, let's use your deadline March earlier, because that's when you said we may see more of those energy policies, the legacy effects of those kick in and exert some downward pressure. In my view, I don't think that would be enough, though, to dampen the inflationary upward pressure that those two inputs are having, because those seem to have been sticky. Because I know we were on Wolf's show a couple of months ago, a year ago now, and I think it was the same thing. Auto insurance and shelter were still the highest. So it's, several months on and that hasn't changed. So, and I don't know the answer to this, so I'm curious to hear what you guys think is, do you think that Trump's energy policies, which let's say they'll be deflationary, but like you also correctly said, why would these companies start shelling out capex only for a smaller margin at lower prices? Do you even think, let's say that happens though, by some miracle, do you think though that that'll be enough to undercut the upward pressure of those two inflationary inputs? My personal opinion is no, but I'm curious to hear what you guys think.
Yeah. So shelter cost is a huge component. It's around 32% of the overall headline CPI, right? And so and we also have to say, okay, you got to separate core PCE and core CPI from blah, blah, blah. Okay, whatever. But I like to look at real stats, and real stats say that shelter has not cracked yet. Based on how they calculate it. Now people are pissed off because it's like, oh, well, Zillow's telling me something completely. Zillow has been telling us that we haven't had pricing pressures on homes for the last 2 years. So Zillow, unfortunately, is disconnected from this from the BLS data, and there's no way of getting around it. You can't change the game while the game is going on right now. So there's going to have to be something that materially changes there. It's just not going to happen right now. So shelter's still sticky. That's a problem. Auto insurance and just insurance in general is going to be sticky. And unfortunately, what you saw what happened in California, homeowners insurance across the United States is going to go up, because if these insurance companies in Cali cannot, well, it kind of depends on what the Fed does too, like federal government does, because usually in this situation, the federal government will subsidize a lot of the insurance companies, right? There's insurance, and then they have reinsurance on that insurance, right? But there's a lot of excessive exposure out there. Numbers of like $200 billion. I think that's actually fairly low, just given the pictures that are out there and just knowing the values of a lot of these homes. Unless these homeowners are going to get completely undercut by insurance, which could also happen here. But let's just say that there's a lot of regulations in Cali that says, hey, like there's a moratorium on like raising prices or even dropping fire insurance and doing all this stuff. These companies that have exposure here, if they know that they have excessive risk in one area and they cannot adjust prices in that area, they will adjust prices in other areas to compensate. And so homeowners insurance itself has been a major pressure point darn there since COVID-19, which is another reason why you're seeing owners equivalent rent going up. And as homeowners insurance goes up, rents go up too. So it's not just the homeowner, like me, I own my home, right? But even if I was renting it, if I'm the person that's renting out my house and my homeowner's insurance goes up $400 or $800 or $1,000, $1,200, I'm immediately raising my prices on rent. Like that's exactly how this stuff happens. And so there's this notion that you're going to have this reset in rental values here, but that notion's been out there for 2 years. Eventually it will come. It's just not showing on the horizon right now. So, okay, shelter's going to still remain in effect, and there's some upward pressures that are going to be there. Commodities have been deflationary for the last year, darn near almost the last year and a half in some respects. A lot of that stuff is basing out. A lot of that's basing out. And the lower dollar, especially if you're looking at ags and livestock, is going to put pricing pressures up. Look at live cattle, look at lean hogs, look at soybeans. Soybeans, I'm pretty darn there sure went limit up this morning, if not darn like close, right? You don't want that to actually happen. You don't want the pendulum to swing back to the other side of that. And so I feel like we're not going to see 6%. Because I think when people talk about inflation now, it's either a boom or bust. It's either like you're getting 7% inflation or it's got to be at 2%. We're going to have sticky inflation. I don't see how we're going to actually crack that by the end of this year. I think we still remain around the high 2.5 or 2.5s, high low 3s when you're looking at PCE. So there's going to be a structural problem there. Let me also say, policies from government take time. And sometimes a lot of policies won't even be reflected until 2 years into an administration, right? There's some things that you're going to see an immediate impact. EV credits going away. Could that have an impact on some values of vehicles? Yeah, maybe. But a lot of the policies is not something that's going to change anything overnight. The energy policy is something that probably you won't even see the residual effects of that until the third year of his administration. Because the energy policy too, one thing that we left out, Dimitri, the CapEx spend's not going up, but the M&A activity has, right? The consolidation in the Permian and Eagle Ford has gone up. So you're seeing a consolidation within the space itself. It doesn't mean that they're making new rigs. They're just buying out the ones that are from existing operations from mid-tier and small cap companies, or even the mom and pop shops that are out there. There's a few of them now after the consolidation. So a lot of this policy, even if you have something that's very favorable, it takes a long time to kind of get that CapEx spend going up, to get production going up. If you want rig prices or you want rig counts to kind of go up, you need margins to go. There's a lot that's going to take. There's a lot that's there. I think you still have the residual Biden economy for the next year and a half until you see any of these meaningful impacts for Trump's stance here for a lot of these things. I don't think it's going to be an overnight thing. And once again, I think the inflation picture still remains sticky there.
Yeah, I mean, I definitely agree it's not going to be an overnight thing, because we saw how, because people have pointed, well, we have the Senate, we have the Congress, we have the White House, we have the, what's the word I'm looking for, of the judicial branch. We have, it's like, not we, the Republicans have all of this, but they also had a leg up during his first term, and yet they actually had a lot of infighting that prevented a lot of policies from being passed. So could that happen again this time? It's unclear. It seems that the Republican Party is less fractured now than it was during his first term, I would argue, to the extent that like Congress and, well, just generally policymakers and investors have had a chance to process, okay, this is what Trump's policies are, this is the bark, this is the bite. And I think for that reason, even though there's, the election outcome clearly was in support of him, I think there is still a risk that there could be congressional infighting, and that could lead to a delay, and that could lead to a policy lag, to the extent that it could delay massive reforms that he's promising. So that's
I think he's only
the risk.
Dimitri, can you correct me if I'm wrong? He's only got he's got 3 vote majority right now, and or it's a 1 vote majority after everybody like leaves that's going into his cabinet. I think it's a 1 vote majority after everybody kind of steps out and gets confirmed, but I think it's 3. So like every single Republican in the House right now wields a boatload of power. So I'm right there with you. I mean, they're going to have to either get Dems on board, or they're going to have to keep everybody in line. And everybody's kind of forgetting about the Senate. Guess what? Those that were just elected to the Senate, they served 6 years. So Trump coming to them and saying, well, we're going to primary you, all of those senators, some of them could say, you know what, I'm going to outlast you here. And I have 6 years right now. And hopefully, if my first year I go against something because you want to cut some spending in my state or what have you, yada, yada, yada. Yeah, that's going to look like a black eye. You're going to hit me up on Fox and News Nation and all these other places. But I got 6 years. I got 6 years to ride this out. So there's some Senate risk that's out there too. I mean, the House is very interesting. It's every 2 years, but the Senate doesn't mean it's going to be a given. A lot of those senators that might have been talking the talk during the campaign might become a little bit more measured when it comes to their approach and their voting style.
They also will have a lot of, and to your point, they'll have a lot of leverage in that regard. Well, they say, you really need me for this. Because who was that one senator, that one congressman who was holding up negotiations of a massive bill that Biden wanted to pass? What was his name? I mean, I know the media was bashing him, but like he's an example of how one man can really stop an entire legislative process until he gets.
Gates?
Sorry?
Gates?
Matt Gaetz? No, it was under Biden. It was a Democrat.
Oh.
Manchin.
Joe
Manchin, thank you. I knew it was something like that. I know it's not Steve Mnuchin, but I knew there was some phonetic similarities there. Yeah, he was an example of how he held up a lot of key legislation. He was one guy.
Hey guys, let's move on to something, because I'm getting a lot of questions. I mean, I'm excited about this. I don't know if anybody else in the world is, but I'm getting a lot of questions on bonds today. So Chris wrote, if your fund was forced to buy sovereign debt, what country or region's debt would you find attractive? I think that's a great question, and I'll go first just to say a couple things. One, I'm a little bit more, at least in the Q1, I'm pretty bullish still. I think the market will do just fine. I don't know about bonds. Personally, I would stay away from them. I think there's much better trades out there than to just try to buy and hold bonds for this whole quarter. However, if you're a person who thinks it's going to bottom, have at it. If it's going to bottom, probably now is the time. But for me, I'd stay away. But the one bonds I'm looking at, and I would actually be partially interested in, and this is going to sound crazy to some people right now. Well, two things. One, preferred stock, possibly high yield bonds, and then finally, if it's government bonds, emerging market bonds. I would look through the emerging market bond complex, and I would try to find areas in there if I had to. Gun to my head. Luckily, there is no gun to my head, but gun to your guys' head. Real quick answer, because we only got a few, and we got one more question after that. So, Kevin or Dimitri?
Time frame, right? If you have something that you can,
We're
hold
talking
for a
long
year,
term. He's talking long term.
I would go long in. That's just me. I mean, it's paying out the higher yield. I probably would do that on the treasury side of it, right? If you're able to stomach maybe some near term pain, I think you go on the long end. They look really attractive, especially this is coming from a millennial that we haven't seen these type of rates in a lot of our investing careers, if you will, right? So I would go long bond there. If you were trying to speculate long Argentina debt, there seems like there's probably going to be a lot more development there. I would just look at South America. I would stay away from anything Middle East, Africa right now. If you're looking at anything that's kind of like somewhat distressed, but I think South America has kind of the best of both worlds right now, where they have depressed currency, they have demand coming from China, and diverse in China trying to diversify their import networks. And then you kind of have this like weird fascination with the new administration and Elon when it comes to South America. So I would probably, those would be more speculative there, but I would go long bond 10, 20s, and 30s.
So, Dimitri, we'll go to the next one because we only have a few. So I'll try to get through these as fast as I can. If they have to leave, I'll try to get through them myself as well. So, interesting times, TLT bottomed, or it's just a Trump fear pump and more downside to come. So, do we think that TLT possibly bottomed, or are we thinking that it's moving back up here?
Dimitri, that's
Dimitri.
Oh, sorry.
Sorry about that. I didn't say your name.
No worries. I know it's not an interesting answer, but it's an honest one. To be honest, I don't know. And I don't want to give hollow speculation on it. So the answer is, I actually don't know.
And that's a good answer.
Yeah, I'm the same. So I'll just tell you how I'm positioned. I am still short. People ask me all the time. I am long the front end. I am short the long end. I'm still holding short the long end because the trend is down. However, if you're a trader trying to trade a reversal, now is possibly the time. However, I don't know either because it doesn't. Either way, it could go either way to me right now. Either we get into a situation where we find inflationary pressures start to fall off of a cliff and bonds start to move back up again, or we're in a situation where I think we're at where inflationary pressures are pretty strong, and bonds are going to struggle. I'm not saying they can't bounce here. I'm just saying I doubt it just reverses right into a beautiful uptrend and it's all puppy dogs and rainbows going forward. If you guys have one more, there's one more question here. Do you guys have time for one more real fast?
Yeah, sure.
Okay, so this is basically saying, Trump is pushing oil, and he's the type of guy to threaten oil companies to produce more. He knows low oil stimulates the market, and so he'll force producers to dump into the market if, in turn, that would hurt fracking.
Can I answer that one?
Yes.
So
please.
Okay,
that's
so
what I figured.
So he did this before. All right. And this is where the geopolitics, and Dimitri probably can shed a lot more light here when it comes to the politics of this. But so Trump was able to pull this off before, but it was not U.S. producers that were doing this, right? At that point, Permian and the shale revolution was just kind of like well, kind of recovering after like kind of getting a little bit undercut back in like 2013, 2014, right? But what he did is he has this vendetta against Iran, and so he basically made a deal with Saudi Arabia. Said, "Hey, Saudi, increase your production. There's going to be some other favorable things for you here. Maybe we look away when it comes to some of these deals. You know, there's also deals that his family personally have with Saudi Arabia and Jared Kushner and all this stuff, right? But he basically got the Saudis to increase production in order to try to alleviate maybe some of the pressures by enforcing the sanctions on Iran, implementing aggressive sanctions and then enforcing them on Iran. The thing that he did not tell the Saudis was that the Americans were also going to continue to ramp up. The Americans were in the secular trend of ramping up production. So that kind of pushed these prices kind of down, and we started seeing, you know, prices for energy kind of go up, go lower. The question is, are the Saudis down to do the same? Because unfortunately, that policy also forced them to spend a lot of money on infrastructure that they're not even utilizing today. In fact, OPEC's pulling production or not increasing production as aggressively as they would like. In Saudi Arabia, it says that they have around 4 million barrels, give or take, that they can bring to market. Some people say it's less, some people say it's more. Let's say that they do have a little bit more. So that's exactly how Trump was able to kind of pull this. And then at the end of the term, obviously we had COVID-19, that threw everything off, right? But what he was able to do is kind of say, hey, Saudi, do this. We need you. In the background, it was kind of like these American companies were like, hey, like the technology is getting better. We're able to have a lot more efficiency when it comes to these rigs, and we're able to churn out more. And it just really didn't materialize when it came to the Iranian thing. I think Trump's biggest thing right now, in order to kind of ramp up production, in my opinion, is that if he can get this, you know, Saudis on board, if he gets the UAE on board to completely isolate Iran, and then basically he gives out that concession to say, look, we isolate Iran because they're bad actors. We're going to enforce sanctions like a mug right now. We want you to supplement that supply, and whatever deal he can kind of come up with. I find that very hard to believe, because the Saudis got screwed the first time, and now they're kind of readjusting their energy infrastructure just in general when it comes to natural gas, when it comes to renewables. But a lot of that's also geopolitical driven that Dimitri can kind of talk about.
Yeah, and when it comes to that, like with me, like when you look at OPEC policy, obviously Saudi is the leader there. There's no question. In order to understand OPEC policy, in my view, you kind of have to understand the domestic policies of each of those countries, but most specifically Saudi Arabia. They're trying to undergo a massive multi-level infrastructure overhaul of their energy sector. Specifically, they're trying not to just be a producer of oil. They're trying to be a producer of alternative energy sources, hydrogen, solar. They're looking to create a different kind of ecosystem. They're looking to have something in there where they have like a gaming and sports center. That's why you're seeing a lot of these Middle Eastern countries bring in a lot of entertainment. In Dubai, it's UFC. A lot of that ties into oil policy, because MBS, Mohammed bin Salman, the Crown Prince of Saudi Arabia, who's de facto running the country, he wants to implement a lot of these policies. That's going to require a very high oil price, or not very high. There's like 3 different tiers, right? There's like your fiscal break even, there's your operational break even, you know, et cetera. So like their operational break even, it's unbelievably low. It's like $10, but their fiscal break even is between $80 and $90. They need that to be high so they can fund a lot of these changes. Now you might say, oh, well, geopolitical risks, those will push oil prices higher. Won't that help? Not over the long term, no, because as we've seen before, those price bumps that they get, the oil prices get from geopolitical risks and supply disruption fears, real or imagined, are only temporary. It's not enough to continue allowing the Saudis to run at a profit margin that they need for these massive reforms. They have a deep interest in keeping oil prices high because they're doing a massive infrastructure overhaul. So I think if you want to understand OPEC policy, look at Saudi's domestic policy, and that helps a lot. Of course, they have to negotiate with other partners, obviously, but it's not controversial to say that what Saudi wants, OPEC does by and large.
No, I love that. And let's end it there. I think that was perfect. I want to thank Dimitri for coming on. Kevin had a thing at the top of the hour as well, so Kevin had to leave. But Dimitri, thank you for hanging out with us. You are always welcome on here. We love having you. And all of you guys for writing in today. Thanks for the questions. These were all great and things that we all, want to talk about and go over as well. So feel free to write us anytime. Make sure to follow Dimitri Pantheon Insights on Substack, also on Twitter. And this is Against All Odds Research. Feel free to follow us, subscribe, hit your notifications, and we'll see you guys soon. Every week we're on Mondays, or if there's a holiday, the next day at 11 a.m. Eastern Time.
Awesome. Thanks for having me on, Jason.